you're talking about a very safe country when it comes to financial markets, Germany. A country which, ever since the Weimar inflation, has been absolutely terrified of ever seeing the devastating consequences of high inflation again. And that's why they have traditionally been very, very frugal in terms of trying to spend within their budget and not borrow too much. But of course, the generation which lived through that Weimar inflation is now gone. And perhaps a lot of the people around today are saying current needs are more important than the damage it's going to do to our children and grandchildren.
Friday, March 7th, 2025, Monaco 64, home of alternative economics and contrarian views. Good morning, Clive.
Good morning, Mario. How are you?
Yeah, as I said before we started, I have a little bit of a cold, but I'm getting better. Hopefully, I'll be fine by Sunday so I can play golf again. And how are you, Clive?
Yeah, it's I'm doing well. I just took my little boy to school. He's 8 years old now, and faster than me. He gets on his scooter and goes at high speed. So, by the time I get to the school, he's long gone.
Good, good. He's becoming more and more independent, which is
That's
a
right.
good
Yes.
thing. Yeah. Um, yeah, I mean, I spoke to you earlier this week and about what's happening in the European government bond markets, especially the German market. That market is the benchmark for all of the European markets, and we're going to look at that. But before that, though, do you want to talk a little bit about the gold silver ratio? And I'm going to bring up this chart that I just put up.
We often look at the ratio between gold and silver, and people talk about it as being 85, 75, 90, 100, that sort of level. That is how many ounces of silver make 1 ounce of gold. And I don't know what it is now. It's maybe something like 90. I haven't got into the details of that. But I was looking, somebody sent me a chart the other day, and they turned it upside down and said, what percentage of is the silver price of the gold price. And that's much more intuitive because it shows right now, if you look at the chart, that silver is right at the bottom. It's at the lowest percentage of gold for, I mean, we had a spike down in 2019, but really at the lowest level we've been for a very, very long time. There's a lot of room for it to go up. So we're about 1 point something percent, and it could easily go up to 4 or 5% of gold, which would mean we would see a quadrupling of the silver price.
Yeah, and I'd also have a chart here. I think where is it? Trying to find it. So many charts. Is it? Oh yeah, I looked at silver versus the S&P, and this is a very long-term chart, and you can see that there's like this falling wedge, which is usually quite bullish. And then there's this trend line from like the early 2000s that broke. I think it was back, must have been kind of back in 2020. And we've been like trying to get back above this line ever since. And it looks like now we're just creeping above the falling wedge and that line, which to me looks really interesting. And like on that chart, Clive, it looks like there's a lot of room for silver to outperform the S&P. And this, I also looked at this chart here a little more short term. So it gives you, from late 90s to now, so you can see where we are. So all you need to do here is take the price of silver and divide it into the S&P index to keep track of this. So I think if we're able to get above 0.006, which doesn't sound much, but it's very significant. Yeah, that's a good way as well. What do you think of looking at it?
Well, I mean, I think another way of looking at it is how skittish is the S&P 500 or the Nasdaq index. Investors are getting to be very, very nervous. A good illustration of that is what happened last night. So, first of all, the as we can see, the stock markets are falling. There is no doubt about that. They are falling. But look what happened last night. There was a company called Marvel Technologies. Now, that's a big company. It was a week ago, 2 weeks ago, it was worth over $100 billion. Last night, and they've had very strong increase in sales. They sell microchips and things like that, and they're doing very well out of this artificial intelligence thing. So last night they came out with their results in line with expectations and very strong growth in sales forecasts going forwards. And guess what? The stock dropped 20%. So it's right that now it's got, a week ago it was at 100 billion. Now it's at 62 billion. It had come off a few in the days before the results, so some people knew the results were going to be bad, were selling the stock. But what this shows is that investors, unless these companies are coming out with results which are even better than the expectations, investors say, "Oh, it's not better than the expectations," and they're selling it. Of course, we saw other stocks like Nvidia and so forth fell very heavily last night. That was down by nearly 6%. So uh, we've got a very skittish and nervous market. So that's coming off. And when people come into cash, they're wondering where to put the money. Now, I had a conversation with somebody yesterday, face to face, and the lady was explaining that she's feeling a bit nervous. She's raised some cash, and her view was that she should put it into gold. She hasn't done it yet. And I said, well, why don't you consider silver? So people will, I think they're coming around to the idea that silver in the portfolio will be useful. And of course, if we have the S&P going down, and the silver price going up, that ratio that you showed now, Mario, is going to get better and better.
Yeah, and here's a chart of the NASDAQ composite. It's a monthly chart, and we've broken like this trend line. And I also heard someone say that I could do the 200-day moving average. Apparently, we broken the 200-day moving average, which had been holding for months, or if not over a year. Um, and let's see what else we got. The other one I've been following is this one, Clive, the Dow Gold ratio, and that is at the lows of let's see, the low has been 1457 this month, and I personally think, as you can see here, that what happened from here to here was that they did loads of QE and they kicked the can down the road. But eventually, we're gonna do what that ratio did back in the 30s, the 60s and 70s, and yeah, we're gonna end up somewhere 1 to 1, maybe even better for gold.
So that would take the gold price considerably higher based on if that chart, if that line goes back to where it should be, we're talking about, well, quadrupling of the gold price, huh?
Yeah,
Something like that.
yeah. And the other thing, Clive, I think you've said this as well, that whatever happened in the first few weeks or months of the year is the general trend for the year. So I've been keeping track of the performance up until a few weeks ago. It was only the NASDAQ that was slightly down. Now, year to date, NASDAQ is kind of accelerated a bit, and now the S&P is down in the year. Dow is kind of unchanged. And I also look at the metals, and with the exception of zinc, all the
All
metals
up.
are up. And look at silver, 13 and a half, and gold, 10.7%.
So, someone out there is buying the gold. We've seen a lot of gold flow from London to New York. Obviously, ostensibly, this has been because of the tariff changes, but at the end of the day, there's been an awful lot of people taking delivery of that gold, far more than is normal. And we don't know into whose hands it's going, but it must be a big buyer because they're taking delivery of 100-ounce bars. So this is not the man in the street. And we know it's not the man in the street because when you look at the ETFs, which is the physical gold ETFs traded in the USA, we can see that the amount of gold in those ETFs has barely changed over the last few years. In fact, it's down over the last 2 or 3 years. The amount of gold in the ETFs as a weight in tons is down. So the gold price has been going up. someone's taking a lot of deliveries of gold, and the retail investor who'd be buying a gold ETF perhaps isn't there. So, and the coin shops, the bullion smelters are saying coins are coming back from the coin dealers. So really the man in the street is not in the gold market yet. Of course, your listeners, they're smart people, they're very clever people, the people who are watching you, Mario, and they do hold gold, but they are the exception. And we're talking about 100,000 people or something like that. It's not a lot of people. Wait till the public at large say, "Oh my God, I've had all this money in the stock market, and it's not performing. Where can I go?" And they're going to be looking around for something else which is holding up well, going up. And of course, the gold and silver are both going up. So I think that it's just a question of time. I'll give it 6 months, but I think people are going to drift over to the precious metals market as they find that their tech stocks are, well, I think they're going lower based on what I see at the moment. I think, Nvidia is above 100. I think it's going below, but probably it's going to go half of that where it is now. It's at 111. I think the NASDAQ 100, which is over 20,000, 20,100 something, 158. I think that's heading down well below 20,000. It's just give it a few months, and I think we'll be there.
Yeah, you spoke about the gold flowing imports in the U.S. and they published a trade balance yesterday, and it's the biggest deficit ever. And I'm going to come up also in a minute with a chart from the Atlanta Fed GDP now, because it's interesting that the GDP equation adds well, it adds exports minus imports. So if imports are really huge, it subtracts away from the deficit, sorry, from the GDP. And just to give you an example how this spike looks more long term, look at this chart, Clive. It's like a really huge drop. And to me, it says that the dollar is still too strong because they're still buying a lot more than they're selling, and that the other currencies are too weak. So I don't think the tariff situation is gonna improve. And here's the GDP now, Clive. Look at the up until the
Yep.
beginning of the year, they expected almost 4% GDP, and now they expect like negative 2.5 or so GDP.
Well, of course, we had the previous administration fudging the figures, and of course now Trump is the president. He's going to try and bring out some truthful figures to make. Obviously, if he makes he'll say he's going to blame all this on Joe Biden, of course. Um, so we're probably getting a little bit of truth at the moment as to what the real number is, and of course it's negative because we're seeing rising unemployment. But what was if you go back to that chart of the massive surge in imports or the trade balance in the United States getting much
Yeah.
much worse, Mario. Um,
Let me,
what's
I
good?
have to bring it up again because
Okay, don't worry. I'll speak while you
I'll
do
do it.
that.
I'll do it. I've got it.
Um, So
I'll,
what we see there is a huge, something like 40 something percent increase in when I say increase, it's that much worse in the
yeah.
trade balance between the USA and the rest of the world. What does that mean? It means that the United States is importing an awful lot more this month than it has been going back as far back as that chart goes. It was, I think it was quite a few years.
Yeah, let me
Um,
got it.
why is that happening? Well, first of all, we've had a strong dollar.
Yeah.
The dollar went from 103 to 110 thereabouts. So that meant that Americans could afford to buy a lot more foreign goods. Secondly, there's the threat of tariffs. Anyone who wanted to bring something to America to sell thought, I better bring it in quickly before they put a tariff on it. So there's been a rush of goods arriving in America. So I'm not really looking at that, although the number looks absolutely terrible for America. I'm not really looking at that month in isolation because we've got these two things. We've had these two things going on: the strong dollar and the threat of tariffs. So that figure, that bad figure, will probably continue for a couple of months until we know for sure what's happening with the tariffs. And I think what we've got in America right now is a lot of nervousness because you don't know which way President Trump is going to jump tomorrow. One day the tariffs are on, then they're off, then he adjusts them, then they're up, then they're down. I mean, where are we? Nobody knows where they are, and that's creating uncertainty, and nobody likes uncertainty. Yeah, it doesn't look good. But of course, since we've had that very high trade deficit, we've seen the dollar come off a bit. It's come down to what is 105, 104 now, 105, I think, from 110. Uh, Obviously, when you have this sort of trade deficit, it's not good for the currency, and we're now seeing the dollar come off. And I think we'll probably go back below 100. I think we're 105 now, if I'm not mistaken,
Yeah.
Mario. They call it the Dixie, the
Yeah, I'll have a
DXY.
look in a minute. I just wanted to point out as well, this is a little different topic, but no, if you notice, like 1970, in the early 70s here, there wasn't, I guess, in proportion, it was probably bigger, if you adjust it for inflation, but it looked a lot more stable than. But Clive, what happened in 1971 that you think made this worse? I think they closed the gold window, so every country was printing and cheating and trying to get as many dollars as possible because they needed the dollars for yeah, to buy everything internationally.
I mean, if I go back to before the 1970s in the UK, we were linked to the British pound was pegged to the US dollar, as were most currencies around the world. So the dollar was pegged to gold, and every other currency was pegged to the dollar. That was what was agreed in the Bretton Woods Agreement of 1944. And the idea of the Bretton Woods Agreement was that instead of moving gold around the world, we could move dollars around the world, which is we could be moved electronically much easier on the certainty that if you had too many dollars, you could just send them to the United States and get your gold. And that was all working really well until 19, sort of 19 late 60s, early 70s, when America became a little bit slow in delivering the gold until they finally said you can't have it in 1971 on the 15th of August. They said, sorry, guys, we're no longer letting you have your gold. I mean, the way they put it was temporarily suspending the convertibility of the dollar into gold. But Britain, if we go back into the before 1970s, was on this fixed exchange rate against the dollar. But every now and then, the problem was Britain was importing more than it was exporting. So when you import more, foreign countries are saying to Britain, give us your dollars. Same thing as saying, give us your gold. So as these dollars drained, Britain would run out of dollars or was running out. So what they would do was have what's called a devaluation. And you'd suddenly see the pound jerk from, let's say, $2.80, £1 worth $2.80 to £1 worth $2.60 and so on, and then $2.40. And it would be a jerk, straight line down of 10 or 20% in a single day. And no, it wasn't just Britain doing this, by the way. It was countries all around the world from time to time would have these devaluations against the dollar. But obviously, at the same time as this was happening, all these countries were accumulating dollars, and America was printing dollars like there's no tomorrow because countries were willing to take the dollars. And that meant in printing dollars, they could buy all these overseas goods, hence what you see on your chart, this ever non-stop trade deficit, of which the one we just saw a few minutes ago, the trade deficit for the month just gone by was the biggest ever in all of history, at least in nominal terms.
Yeah, yeah, that's right. So I spoke earlier about the European bond market, in particular the German bond market, because it's been leading the way. And it's interesting, Clive, that back in 1994, when I was working in the city, I used to be a futures and options broker for government bonds, and I traded a lot of bunds. At the time, they were in Deutschmarks. And I remember in 1994, German M3 was expected to come out at like 4% year on year, and it came out at 30% or so. And it was the busiest day I ever had at work as a broker. I was holding like three handsets for the phone. I even, Clive, made because I was in the dealing room and we had a guy, he was called the link to the Bund booth in the exchange. And we used to, we were all shouting orders to him or even using hand signals. And yeah, it was really hectic. And the next day, I found out that I'd made an error. I put an order in twice because I thought the link I hadn't gotten it. Luckily, Clive, that order turned out to make $50,000 for for my firm, which was really I was really relieved. And of course, I didn't keep the money because it could have been a loss of 50,000. So I think this is the biggest move in the reason I'm talking about this is because I think the rise in yields that we've seen this week is probably the biggest in the German government bond market since then. Of course, we had the European, the pigs, Portugal, Italy, Ireland, Greece, and Spain crisis in 2011, 2012. So this came out of, well, kind of out of left field, Clive. I mean, the Germans, they've always been very frugal and they've always been for sound money. But can you tell the viewers what's happening now in Germany in
Well,
terms of fiscal policy?
well, they basically just decided to spend $500 billion on bombs or weapons or whatever you like to call it. I mean, I think they probably were a bit more vague. They probably said it was um, defense and infrastructure or something like that. But realistically speaking, they're going to spend it on defense. And what they've said is basically, we're not going to count this as debt. We're going to borrow the money, but it's not going to count towards our debt budgets or anything else. We'll just or our trade. It won't count towards anything. We're going to spend the money anyway. So basically, they will have to borrow 500 billion over time, and that's what's pushed the bond price down and the yield up.
Yeah.
And
So
if you look at it, it was a huge spike in the
yeah,
last day or two.
yeah. I mean, yeah, you can really see it here. So let's have a look. It was up until, let's say, late last, well, early last year was below 2%. And let's say November 2024 was at around 2%. And then we spiked from 2.37 to almost 3. And so this is a longer term chart going back to the 70s. Um, and I think a lot of people, Clive, expected this to go down because despite what's going on in the bond markets in Europe, the ECB cut interest rates yesterday, which in my opinion is the totally wrong thing to do because it's going to make it even more inflationary. But if we break, I think the key level here is to 3%, even though this is on a closing basis.
We're at what, 2.83 or something like that at the moment, I think.
Yeah, yeah, 2.81. It's come off a little bit.
Hmm.
But I think if we go above 3%, we could in the next few years see these yields go up to 5, 6. And I don't think these politicians realize how damaging that's going to be. Yes, they're going to do, and it might even scupper their efforts to build the military up.
Well, you're talking about a very safe country when it comes to financial markets, Germany. A country which, ever since the Weimar inflation, has been absolutely terrified of ever seeing the devastating consequences of high inflation again. And that's why they have traditionally been very, very frugal in terms of trying to spend within their budget and not borrow too much. But of course, the generation which lived through that Weimar inflation is now gone. And perhaps a lot of the people around today are saying current needs are more important than the damage it's going to do to our children and grandchildren. And of course, you say what will happen if yields in Europe go above 2% or 3%. Well, let's look at Italy, 3.9%, 3.93%. Same currency,
Yeah,
euros. It's more than 1% higher than Germany. Spain's at 3.5% on 10 years. Greece is at 3.7. France is at 3.55. They're all above 3% now,
Yeah.
and well above the German rate, which is the safest rate. But that German rate is now starting to rise as well.
Yeah, and I mean, and the German government bond is the benchmark for ho the whole of Europe. So if the German bond yields keep rising, you can bet the Italian and all the other ones are going to do the same. And compared to UK and Britain, I think the Italian's still really relatively low. So I think there's a lot of potential for that to go higher, and it's going to hurt the economy. I think of Europe, and it's going to ho hurt the whole world, in my opinion.
Yeah. I mean, as you talk about UK, we've seen what's happening to the UK 10-year yield. Um, we've gone past, well past the level at which we had the crisis. The crisis was saw the gilt yield on the 10-year going to 4.8, something like that in the UK. We're now well above 5%
Yeah,
on the
that's the
10-year.
30 years.
Oh, is that the 30 big one? Yeah, that's
Yeah,
30 year, isn't it? Yeah.
yeah. But
So
yeah, that was the Liz Truss crisis. I mean, we're way above that. And
So
yeah,
this is obviously very damaging for pension funds. So if you have a pension fund in the UK, you need to be you need to be thinking about how you can save outside of your pension fund, because those pension funds will be suffering, and because now the price of the assets they hold, the bonds at least, will have fallen in price, but they're still having to pay out to the current pensioners. So that means what's left for the rest of the people is probably getting smaller.
yeah, I think one place, and you probably agree with me that people need to be looking at is gold, of course. And here in the UK, um, coins of the realm, of course, 1 ounce Britannias or sovereigns, half sovereigns. I think they even have a quarter sovereigns now. And if you're looking to add on or buy for the first time, check out Gold Investments. They're my affiliate. They've been in business, Clive, since 1981. So they're a reputable dealer. All the details.
There's a lot to be said for dealing with companies which have been in business for a very long time, as opposed to some potentially fly-by-night company. I have to get people write to me, Mario, and say, "What do you think about this company or that company?" And for buying gold, and I won't say any names. I look at them, and quite often they're fairly new companies, last year or two. And what's worse, these are people are wanting to put their money. These companies are proposing to store the gold or the silver for the buyer. Uh, Fair enough. But you're dealing with something which hasn't been around for very long. And do you trust them to store your gold or silver for you? Yeah, and there was one person who wrote to me and said, I tried to get it out from a particular company. And he said, I've been waiting. I can't remember how long he said, but it was he'd been waiting a very, very long time, maybe months. And they wouldn't deliver his gold. And there was some problem. Maybe
Yeah.
they were claiming money laundering and God knows what. Uh, but my point is this: if you're going to deal in gold and silver, go with the ones which have been around for a long time, which is like the company you said, Mario.
Yeah, and Gold Investments, you've got Oliver Temple and Simon, their brothers. I used to deal with their dad, Mike Temple. He's retired now, but and they also store it. Uh, I, I mean, and they'll take you to the vault to show you your gold. Like you can take it to their office and they'll count everything and write down what you have exactly. It's not like they're gonna give you something else. There's a small charge.
Am I right in thinking that if they store it for you, you actually get your own box? Is that how they do it? Have
No,
they?
I mean you take it to their office in a box and they count it and then you close your box or yeah, and then they have a vault in London, a private vault, and it's all insured as well.
So
And
you actually have, if you have coins of a particular date, you get back exactly the
oh,
same coins.
exactly. Oh, yeah,
Yeah, it's not like a big pot where they
oh
say,
no, 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 no.
yeah, we owe you 100 ounces of gold and we'll give
No,
you anybody's
and they
gold.
give you a certificate with a waxed stamp.
Hmm.
They stamp on the wax and they write down all the coins you have and how many, all the dates and everything. So yeah, anyway, if you're interested, there are links below. There's a link below in the description how to get in touch with them, and I also have some promo codes that you can use to get a slightly better deal than the public would on with them. And you can use their website, which is a new website now, or you can phone them, which is nice to get a service that you can speak to people. What about Japan, Clive?
Yeah,
Because
wow.
that is the mother of all bond bubbles, isn't it? And that's starting
I
to,
mean, look what's going on. The rates are going up, up, and up and up like a rocket.
yeah, JGB. And it's still, there's still a long way to go because these rates used to be
So,
around 5 or 6.
again, if you're a Japanese bank and one of your major assets happens to be government bonds because you thought they were a nice, safe investment where you could earn something more than zero, um, those bonds will be falling in price rapidly. So let's say, as an example, you had a 10-year bond and the yield rises by 1%. Well, that means you've lost effectively 10% on the price of the bond. So how's that going to fit with their reserves? So Japanese banks will be seeing their reserves declining. I don't know if any are under threat. Somebody told me that one of the Japanese banks, and I don't know which one it was currently under threat due to this change in interest rates now. But when of course, if you see the rate going from what's happened here, it was negative and then it was zero point 0.1 and it's now gone to 1 point something. It's the highest rate in
Almost
many,
one
many
and a
years,
half, it looks like a
one and a
pop.
half. So that's 15 times the rate it was at zero point 0.1. So what are we, someone out there will be at the wrong end of this. And
Yeah.
we don't know who it is. There always is someone at the wrong end when the price of anything changes a lot.
What this is telling me, Clive, is that not just in Japan, but in Europe and even in the US, if yields start rising sharply and quickly, we're going to have more banking problems. And if you look at the Japanese national debt here, the public debt to GDP is almost 300%, which is huge. So,
Well, we've got Basel III coming, which is supposed to make the banks safer. But as far as I can tell, Europe, Great Britain, and America have all said effectively, screw that, we'll put it into the future. So we didn't make our banks any safer.
yeah, someone has been saying that America is actually going to implement that this summer, but and maybe that's why gold is going to America physical, but I'm not too sure. The other thing, Clive, is that I don't know if you remember in 2020 during that crisis we had, which I won't use the name, uh, Jay Powell cut the reserve requirement ratio for banks to 0, and it's still there, which means these banks are still highly leveraged, in my opinion. I looked at some reserve requirements once from the 70s for UK banks, and they used to keep like 12.5% of their reserves. Um, now it's like there's no reserve requirement ratio, which sounds crazy to me.
You touched on something there which might be of interest to your listeners on the effect of Basel III on gold. Under Basel III, gold will be treated as a tier one asset. That means uh, it will be regarded by the authorities as safe and sound as treasury bonds, treasury bills. It's the safest possible asset a bank can hold for the purposes of its reserves. So if it holds treasuries or gold, it doesn't need to have so many reserves and other things. So it can have less reserves in treasury and gold or more in other types of things. So what I think will happen if these countries, America, Europe, these areas, America, Europe, and
Japan?
where else? No, I think Japan are adopting it. Uh, I said it earlier. Anyway, but
UK?
anyway, UK, yeah, that's it. If these three countries or areas adopt Basel III, it's quite obvious to me that the banks will say, diversify our reserves, don't keep it all in treasuries or gilts or whatever. Let's have other things, and they will put gold in the portfolio, and that will be very good for the gold price when it happens. And
Yeah.
of course, some of the banks in America might be out anticipating this in advance, if indeed they might implement it in August. Although I kind of heard that they keep pushing it back.
Yeah, Clive, just before we wrap up, just want to show you and the viewers this chart. You probably remember this chart. And if you I showed a NASDAQ chart earlier and it was breaking down. But this is the gold chart and it's monthly. And I like the monthly one because it takes away all the noise. And to me, that looks like a chart that's breaking out, not going down. So yeah, I just wanted to put that out there. And Clive, the other thing that I've seen some people be worried about right now is, for example, the euro and the pound have gone up quite sharply versus the dollar, and gold hasn't kept up. So I had someone contact me and say they're worried because they bought gold last year, this year, and it's going down in euros. And I told them, well, this happened in when I bought gold in 2002. I remember in dollars, gold started going up, and but in pounds, the pound was relatively strong versus dollar, and I was really frustrated. It was doing nothing, but eventually after '05, '06, it caught up. So what I'm trying to tell people who think in euros or pounds, I don't think you should be concerned because these currencies they take turn to devalue or revalue against each other. Is that how you look at it too?
Well, I don't think there's any point. If you buy an ounce of gold, I don't think there's any point in watching the price. I mean, does the guy look at the price of his house and say, "Oh, it went up or it went down"? When you own something, you're owning it for the long term. It's like an heirloom, and you only are going to cash it in the event of emergency. Now, of course, if this guy happens to be a trader and he's on some contract for difference site where he's buying and selling it and trying to make money every week, then he's a fool. He's going to lose all his money. But most of your listeners are people who buy their gold to keep for literally forever to pass down to their children and their grandchildren, and they'll cash it in the event of an emergency, and they go into the gold in the knowledge that no matter what happens to the world's currencies, in all probability, if they have to cash in their gold, it will buy them just as much in the future as it would buy them today. That's not going to change, and it's been like that for thousands of years. So that's why people buy gold. So those people who are looking at the day-to-day prices, are obviously sort of thinking, if it goes up, I'll sell it. Well, you know, you're not really it's not really the same game, and
Yeah.
those people don't even need to buy the physical. They could go onto one of these contract for differences sites and gamble away their money. But you know, all these sites which do this sort of thing, they have a rule, which or not a rule. They have a internal expression. They call it the 90 rule, and that basically says that 90% of the people who trade with them will have lost 90% of what they put in within 90 days.
That's
Okay,
interesting.
that's they don't spread that around. I mean, if you look at the small print, they actually do say it in the small
Yeah,
print.
yeah, I've seen that. And
But
I've seen on my IG.com where I have my ISA and you can do spread betting. They say they put something saying 68% of the people who trade the spread bet lose money.
yeah, that's in the first week.
Yeah. And but I think yeah, what you said, yeah, it's like it's generational wealth, but it's also, I think, right now with the way the world is, it's also an insurance against major financial crisis. And it's like life insurance or fire insurance or insurance for your car. You're not going to keep watching what it's worth and trading it around. So yeah, that's it, Clive. So any final words as we go into the weekend? Oh yeah, Clive, we've got non-farm payrolls today, the U.S. jobs data. That should move the market short term.
Maybe. The only final word I've got is the US debt ceiling, which is not even being debated yet. It's in place. The bankruptcy date, the date where they run out of the money from emergency measures. Emergency measures basically means they're stealing the money from their pension funds and things like that. The day they run out of the emergency measures will be it's a moving target, but it'll probably be sometime in early August, maybe late July. So that's something to keep an eye on. Unless they raise the debt ceiling before then, we could have a default. Of course, they're almost certainly going to raise the debt ceiling before then, but it's not guaranteed in stone. And as they get closer to the date, the rating agencies are going to get more nervous.
Yeah, and they could abolish the debt ceiling as well, and I think that would be yeah, because it keeps rising, but that could make things really more interesting because it would put no limit on Congress on what they spend. So yeah, I'm gonna wish you all a great weekend, and you as well, Clive, and we'll talk on Sunday. We'll do the live
Yeah,
stream on Sunday this weekend.
great. Thumbs up,
Yeah,
and
thumbs
thanks
up.
very much. Bye
You're
bye,
welcome.
Mario.
Bye.